You've spent years building something from nothing. You found a deal, you operated it, and you grew it. And now, finally, liquidity is starting to show up. But here's the question no one ever talks about. Now that you've made the money, what do you do with it? How do you protect it? How do you make it work for you without letting it consume your attention the way building your business once did? And how do you make sure that wealth outlives you? Not just numbers, but also in values. That's what we are exploring today, because the goal isn't to get rich once, it's to stay wealthy purposefully for generations. In the world of holding companies, search funds, and business buyers, most of the conversation stops at acquisition. We talk about debt, we talk about diligence and EBITDA, we talk about operational improvement, capital allocation, and portfolio building. But wealth management, personal capital allocation, almost never comes up. Yet, this is exactly what separates the first generation builder from the second and third generation steward. I've talked to more than 100 entrepreneurs who've acquired 1, 2, some even 30 companies. They're all incredible operators, heads down, grinding, building real value. But very few have a plan for what happens after. Because in truth, it's a different skill set. Running a business and managing personal wealth are two different games, and confusing the two can be costly. Yes, there are families who have been doing that for generations, and this is nothing new for them. But if you look at who does it super well, they all have one thing in common: discipline over time. Yes, there are families who have been doing that for generations. There is nothing new. And if you look what they do well, there is one thing in common, and this is discipline over time. And some of the examples where families have been able to maintain their wealth for 200 years by simply chasing returns. They did it by managing risk and teaching the next generation how to preserve, not just spend. And their family values have been through trusts and foundations that embedded purpose into structure. And we all know those names, and those families are still extremely wealthy. On the other hand, there are some families which used to be the richest in America, but they've been able to lose it all within 3 generations because the wealth was treated like lifestyle fuel, not stewardship capital. What they did was they built mansions instead of mechanism for compounding. And in Asia, there is a saying, from rice field to rice field. What it means is the first generation does all the hard work, builds a huge wealth over their career for 30, 40, 50 years of working. Then the second generation comes, they spend quite a lot of it because they don't have the right values. And the third generation, again, they're struggling. That's why it's from the rice field to the rice field. So that's the pattern. When wealth becomes about display, it decays. When it's about discipline, it compounds. The other day I was posting on X about this wealthy families, and they sometimes go and have a conference in Aspen or Davos. And the tweet was about why should they even travel there. But one of the things was that they're skiing, they're enjoying time with their families, and they just come up with this strategy for the next following decades. And the goal is very simple: to get the fundamentals in place where you save more than you spend, you own productive assets, you avoid leverage that can ruin you, and you focus on compounding and not just about consumption. So it's all very simple. The simple things, oftentimes they don't sell. What does is the complexity. So many builders, even the smartest ones, outsource their thinking before they've developed their own wealth philosophy. And that's dangerous, because that's how fortunes may fade. Now, let's come back to the first generation builder. Let's take you, the operator, the acquirer. When do you ever stop and think about your own wealth strategy? You're running companies, you're managing teams, solving problems. You're very often away from your family for weeks or months because there is this business trip which you have to make. There is some people you have to meet. There are some companies you have to look at. you're away from your family. So you're reinvesting all your profits, you're chasing those deals, you're hiring people. But when do you step back and say, how do I make sure all this work endures? Because wealth without the framework is fragile. It's not about how much you earn, it's about how you structure, how you protect, and how you redeploy it. And after speaking with dozens of operators and seasoned investors, and at the same time, I've talked to smart wealth managers who've been doing that for a living for a long time. And there's this two-bucket philosophy. Number one is capital preservation, simply ensuring that no matter what happens in the market or in your business, your base stays intact. And then there is balanced and compounded growth, which is growing what's left intelligently and over time. It all sounds very simple, but it requires clear thinking and structure. And the best way to visualize it is through a three-part strategy that could help. The first pillar is conservative fixed income. This is your ballast, the part of your portfolio that keeps you stable when the world gets noisy. It provides liquidity to take advantage of market and life dislocations. It includes cash, short-term maturities, very high-quality assets with low volatility. It's not meant to impress anyone, it's meant to preserve optionality. Thanks to the following on X, I once met a man who sold his construction company for almost 20 million. And within a year, half of it was gone. He'd diversified that into venture capital, luxury condo, and a private crypto fund. He wasn't really investing, he was just gambling into the next shiny object, and it was a massive mistake. And there was another conversation where you can just contrast that with another entrepreneur who sold his HVAC business for pretty much the same amount. What he did was very different. He put 60% of the proceeds into municipal bonds and short-term treasuries, then took his time deciding what to do with the rest. And that liquidity became his flexibility. What is the big lesson here is you don't need to swing hard once you already hit the home run. Hey, a very quick break from the episode because I want to talk about today's sponsor, CapitalBat. This is the marketplace built for acquisition entrepreneurs and investors who think long term. So if you're buying a business and need equity partners, or you're an investor looking to back great operators, CapitalBat connects both sides with standardized terms, governance, and distributions, so everyone is aligned from day one. It's where builders meet backers, people who care about cash flow, not just hype. So whether you're raising capital for your next deal or you're looking to allocate into real operating companies, visit capitalbat.com and explore the new infrastructure of small business investing. I'll also put the link in the description as well. That's capitalbat.com. And now back to the show. The second pillar is high income strategy. This is where you seek above average yield across diversified sources. Take corporate credit, preferred shares, real estate debt, or even well-structured private lending. Every holding must pay you consistent income. This is how you decouple your lifestyle from your labor. It's how you let your capital work while you focus on building or enjoying life. There is an old saying among wealthy families, income buys peace, principal buys pride. The families that stay rich never rely on the ladder. They live off the income. They reinvest the excess. Think of a Midwestern family that owns 50 small-town apartment buildings. They don't chase new projects every year. They just collect rent, pay debt, and compound. They do it often very quietly, predictably, and they do it forever. That's what this bucket represents. Now, the third pillar is long-term growth. This is the fun part. It's owning great companies for years. Public or private, doesn't really matter. What matters is durability. It has to have low debt, strong margins, and exceptional leadership. The goal here is time in the market, not timing the market. Most investors sabotage their returns by selling too early or trading too often. Recently, I've been listening some other podcasts with some of the hedge fund managers, and they keep saying the same thing. They were just selling too early. They made the right decision buying the shares of a public company, but the biggest mistake they made was just selling too early. So there's a big lesson here, because compounding only works if you let it. Let's take Warren Buffett. His genius isn't stock picking, it's patience. The same patience that business builders use when they grow a company from 1 million to 20 million should now be applied to their investment portfolio. Own great businesses and hold them for a long, long time. Let the reinvestment of growing dividends and capital appreciation do their work. It's not about chasing the next big thing. It's about building a system that compounds quietly in the background while you live your life. Most wealth doesn't vanish through one bad deal. It evaporates through lifestyle inflation. You start justifying the car, the trip, the second home, one reward at a time. But every indulgence interrupts compounding. Every generation must choose between consumption and compounding. One leads to comfort, the other leads to freedom. And freedom requires restraint. It's a muscle which builders already developed in the business. The wealthiest families don't just manage money, they manage meaning. They use family meetings, trusts, and foundations to keep the why alive. A third generation entrepreneur told me some time ago, our family doesn't talk about how much money we have. We talked about what it's for. Purpose turns capital into legacy. And wealth management isn't about spreadsheets, it's about the temperament. You don't need to run your portfolio like a hedge fund. You already manage complexity in your businesses. Design a structure you understand, stick with it, and give compounding time to work. Charlie Munger have said, the big money isn't in buying or the selling, it's in the waiting. So for the builders, the real challenge starts after success. For example, selling the business, paying great amount of dividends. Once you have the capital, ask yourself, can you manage yourself as well as you manage your company? Wealth at its best is a tool for time and choice. You've proven you can create. Now preserve, compound, and pass it on, not just as money, but as meaning. This isn't the end of your entrepreneurial story. It's Act 2. If you apply the same discipline to your personal balance sheet, you won't just stay wealthy, you'll build something rarer, a dynasty of ideas, values, and opportunity that keeps compounding long after you're gone. So this has been Holdco Builders. If you found this valuable, share it with someone who's building their own story and maybe hasn't yet thought about how to protect what they're building. Because wealth isn't the finish line, it's the foundation for the next chapter. So I hope you found this episode, How Builders Build Wealth That Lasts, valuable. Again, share it with your friend who maybe had a liquidity event. And if you found it valuable, add some comments, some questions. If you're first time in here, make sure you follow, make sure you subscribe, and we'll see you in the next episode.